ask your accountant these questions. If they don't have good answers for them, that is a massive red flag.
Episode 220 of the Dan Bradbury podcast. I'm excited again to be back in Leamington Spa at 1 Mill Street Studios, and I'm even more excited with this new format. It's flowing and going, and I'm loving it. No more news of the week or anything like that. We're just getting straight into really great business strategy. But this podcast is a little bit interesting because you have a guest.
Yeah, I'm super excited. This is one of my favorite accountants in the whole world. I mean,
oh wow, you just sold me.
Yeah.
Nerds, wake up! You're gonna love this segment.
Listen, expenses are tax is most businesses' single biggest expense category. You spend a high percentage of money to HMRC than any other expense category. So you need a shit hot accountant, and this guy, in my opinion, is the best in the business. Yeah, so
the best in the business. That's a strong endorsement.
So let's go to Chris Wilkins from Wilkins Southworth.
Mr. Wilkins, thank you very much for joining us on the podcast.
Morning, Dan. Nice to have it all live for once.
Yeah, it is. Well, listen, there's so many things and topics I want to go into today. I mean, obviously, a lot of people, Chris, come into my world that are business owners looking to scale, and but it stuns me how many are financially unaware. And I think I might have told you that when people join our programs, there's about a 50% fatality rate of their relationship with their accountants. That is, they quickly realized that their accountant isn't up to stuff. So probably a good place to start, Chris, is I want to lead with, why is it essential if somebody's trying to scale business to want to have a stronger accountant or accounting firm in their corner? But before even that, right, wind up, I think a lot of people have got misconceptions about what an accountant is and what do they do. So could you kind of
So what a lot of people don't realise is that, unlike solicitor, the word accountant is not a legally privileged word. So you can't call yourself a solicitor unless you're qualified. But if you wanted to set up tomorrow as ABC Limited accountants, no one's going to stop you. You've got, as I understand it, no qualifications. So what you do find is there's a lot of people that don't know. When I have clients come to me and they say, this person has messed up my accounts, and I say, are they qualified? And they'll say yes. And when you look, they've got the equivalent of a bookkeeping qualification. So there's only really two bodies that can audit limited companies. There's the Association of Chartered Certified Accountants, which we are a member of. And if you are a member of that, you then have a separate qualification if you're a registered auditor, which we have. So sometimes that may come out if you want a mortgage. So the mortgage company will say, and this is for a set of accounts that doesn't need an audit, but they'll say, can I have a letter to my mortgage company? Now the mortgage company will say, what qualification does the accountant have? And if they aren't ACCA or one of the other ones, then the chances are that they may not like your set of accounts because they're unaudited and not prepared by a firm of qualified accountants. So that means that you could end up with your accountant being ABC Limited. So a client came to me and said, I've just realised that my accountant has done my accounts wrong. I've got an HMRC inquiry and he hasn't sent them to company's house, and I've got fines all over the place. Can you tell me where I write to the professional body to complain? I said, there isn't a professional body because they're not qualified. Okay. Can I sue his limited company? Yes, you can, but there's only £100 in the balance sheet of that company, so that won't get you anywhere. Okay. Does he have professional indemnity insurance? Well, we have to have professional indemnity insurance for all our clients. Our files are checked by our professional body. This person, they don't have to have professional indemnity insurance because they aren't in a recognised body. So therefore, there's no one actually checking their files to make sure they've got most up-to-date advice. So basically, the client I've just got has got no recourse to that previous firm. And the chances are they will just close that limited company and start another one tomorrow. There's no professional body that they can complain to. There's no professional indemnity they can get out of them. And my client then has a revenue inquiry that we try and pick up. And the chances are the guy has already started it and messed it up, or lady, whoever the accountant is. And then what happens, they've got the fines from Companies House and HMRC. And they might have gone to that firm to save a couple of £100 on accountancy fees, and the fines are just exponentially bigger, and the revenue inquiry could take 18 months, and then you're stuck with sorting that out. And what you often find with these inquiries is someone starts it, not only have they opened the stable door, but generally the horses are right down the road. That's my analogy on an HMRC inquiry. And then you have to pick up an inquiry that's part of the way through, and the incumbent accountants, i.e. the previous firm, have already messed it up. So that's the initial problem, i.e. do you have a firm of accountants who are qualified? And are they registered auditors? They don't have to be registered auditors if your accounts don't need an audit. But to give you an idea, I was asked to look at a set of accounts last week. They used a firm of accountants that aren't qualified. And we looked at it and said, I'm very sorry, but you should have had an audit. They said, but what do you mean? I said, well, you've signed the balance sheet to say I don't need an audit, but for the last 2 years, you've passed the audit thresholds. So the audit thresholds generally are, you need to fail 2 of the 3 tests. Is your turnover over £10.2 million per annum? Is your balance sheet assets, i.e. fixed assets plus current assets, over 5.1 million, and do you have more than 50 staff? You can fail one of those tests. If you fail 2 or 3 tests, you need an audit. And in this case, this client had failed the test for 2 years, and therefore the accounts they'd sent to Companies House were wrong because they'd signed on the balance sheet to say the company didn't need an audit. And they said to me, but my accountant didn't tell you. And I said, but your accountant is not qualified. They don't know the rules. And then what happens now, they want us to re-audit those accounts, and they've already paid that accountant to do the accounts.
Yeah.
So the whole lot will have to be done again because they need an audit.
It's fascinating, Chris. I mean, we've probably already scared some people listening to this. And I suppose the question that occurs to me is, beyond, obviously, you could say, well, qualifications, that even when you get rid of the people that aren't suitably qualified, there's a lot of people that are qualified that aren't competent. So how would somebody who's not an accountant, they're not financially trained, how would you suggest somebody filters? How would they calibrate whether or not it's a competent accountancy firm in the corner? What's important for them to look for?
Well, to start with, it was word of mouth's very good. And you were referred to us by Mark Homer of Progressive Property Ventures and Rutt Moore, who we act for, and also Richard Davies, who runs Platinum Property Partners. Now, you did your sort of due diligence on me. You asked me relevant questions. If you don't know that, then, and if you come across a name, you need to inquire into that person even more. So, if for the sake of argument you have an HMRC inquiry, I would be asking the accountant, have you dealt with HMRC inquiries? What type of inquiries have you got? So, to give you an idea, HMRC inquiries can start from everything simple called a Section 9A inquiry. It might be they get the accounts and they say, oh, motor expenses look a bit expensive, bit high. Can you give me a breakdown of those, please? Or you could get complicated ones, and a complicated one would be an example, say, a multi-jurisdictional one. So an example of that would be Lester Peggott, and he had a Code of Practice 9 inquiry. And the Code of Practice 9 inquiry are about the most complicated ones you can get. And just for those of your listeners who aren't aware, Lester Peggott was a very famous jockey. And he had an inquiry from a local inspector, and they said, we just want to check your income. Can you tell us where your income came from in May? And he said, well, on the 2nd of May, I was riding, I think I did the 10:30 at Kempton. Then I got a helicopter over to Ireland, and I was had a race in Ireland. Then I got a helicopter over to France, and I had a race in France. And suddenly it becomes multi-jurisdictional. And then you get passed to a special department in Wolverhampton. And Code of Practice 9 is what's called civil fraud. And what that means is that it's not a criminal offence as long as you tell the whole truth to HMRC. At the end of it, you have to do a report to HMRC and you sign basically to give them a list of all your assets and all your liabilities. Now, at this stage, I think it was Sir Lester Bigger. And at the culmination of this inquiry, he did a summary of all his assets and all his liabilities. And HMRC said, we worked it out, Lester, and you owe us, I can't remember the figure, but it was a lot of money, like £400,000. And he said, wow, that's a big figure. I'm going to check it with my accountants, then I'll find out what's happened. So he checked it with his accountants. The accountant said, yeah, there is interest and penalties. And just to give you an idea, penalties could be as high as 100% of the tax bill. So a good accountant, his job would be to mitigate those penalties and to minimise the interest charges on your tax, as well as negotiating the tax bill. So they said, yep, I think it's right, you better pay it. So Lester Piggott then sent them a cheque to pay his tax bill. The only trouble was, Lester sent them a cheque on a bank account he'd never disclosed.
Right.
So then what happened is Lester Piggott lost his knighthood and ended up in jail. And that's a Code of Practice 9. And so the civil offence becomes a criminal offence. And so we've done a Code of Practice 9 inquiry with a client of ours, a property client, multi-jurisdictional, they were buying properties overseas. And so the point is that you need to ask your accountant what type of inquiries they deal with, how complicated, how regularly they deal with these inquiries, what's their success rate, etc. So generally, we just don't fail on these things because you try and make sure that you minimise the problems with the client. So in this case, the client we got for Code of Practice 9 was done by another accountant. He said it's getting too complicated, so he passed it to us. But unfortunately, he had already given some of the wrong answers to HMRC in the first place.
Yeah, I mean, it's fascinating. I always find, Chris, that if I'll speak to somebody who will say, oh, my accountant's good, they're a good accountant. I say, well, how do you know? And they'll say some version of, well, like they've done my accounts for years, they've saved me loads of tax or whatever. And my question is, well, compared to what? If I say, have you ever had not even an inquiry, an investigation? And it's astonishing for me how many people, they just don't have any references. I mean, if I've got to go to battle with HMRC, I don't want to, you wouldn't want to be a heart surgeon's first surgery. You don't want to be the first surgery out of med school, right? You want somebody that's been there and done that. And well, as you alluded to, the reason we came together is because I had a problem. And I went to knowing Mark Homer and Richard Davis, who are both very, I personally deem to be extremely financially astute. And the fact that both of them have done business review for well over a decade, and neither suffers fools gladly, was definitely a good jumping off point for me. But so tell me this. Let's whet the listeners' appetite a bit, Chris. I mean, you've mentioned some things already, but what are some of the most common mistakes that you see business owners make? Because somebody's perhaps listening to this and going, well, you know what? I've got an accountant. There's nothing massively broken, I don't think. But what is it that they should be aware of? Or what are the questions that they're asking? Or where might they look to find, what are some of the most common mistakes or or problems that small business owners have inside of their accounts that they're not even aware that they're making?
So I think I would refer you to Donald Rumsfeld, the American politician. And he said there's known knowns and unknown knowns. And the biggest problem is the unknown knowns. And what happens is that, a bit like getting a heart surgeon that's never done one before, if you get an accountant that is sort of the run-of-the-mill accountant, they don't get involved in complicated stuff, they don't know what they don't know. So to give you an idea, we've just picked up a new client, and he said, I'm just selling my business. And I said, that's fantastic. How much are you going to sell it for? He said, £2 million. And my wife and I are going to make £1 million capital gain each. So you may be aware that in the old days, they had something called entrepreneur's relief. And entrepreneur's relief was the first £10 million of capital gain was assessed at 10%. Thereafter, you paid the going rate of capital gains tax, which is on the sale of shares, is 20%. So if husband and wife owned half the business each, they could make £20 million at 10%. Then that was abolished, about 3 years ago, and they brought in something called BAD-R, which is Business Asset Disposal Relief. And BAD-R is basically the new version of Entrepreneurs Relief, but it's not as beneficial. So I ran through this with my new client, and I said, I've done a search at Companies House, and I notice you're the only director of the company. So for BAD-R, you have to have shares in a trading company. And each person that claims BAD-R has to have at least 5% of the shares in the trading company. So he said, yeah, that's fine, because my wife and I own 50% in his trading company. So that's great. And we've owned that for 2 years. So we tick those boxes. And I said, then you have to be a director or employee. And he said, I am a director. I said, and your wife? No, she's not a director. Is she an employee? No. Did your accountant tell you the rules of BAD-R? Well, he forgot that one. So what happened is he told him the 5%. He didn't tell him that his wife had to be a director. So his wife is now going to pay 20% tax on that £1 million rather than 10%. So so that client was sitting there over 3 years ago in the knowledge that he would have claimed BAD-R on the sale of the company for his wife's shares, and he could never have claimed that. So some of the stuff, I mean, we're doing one at the moment where we're doing tax planning now for 5 or 7 years ahead. 5 years is because the guy wants to exit. And when he exits, we're going to do a company buyback of shares. And to satisfy those rules, he has to have something in place for 5 years. If we're doing anything for inheritance tax, for potentially exempt transfers, that has to be 7 years in place. So what you've got to think about is the way you set things up now. We're setting this company up because we know what's going to happen, cross fingers, in 5 years' time or 7 years' time. If the accountant doesn't plan for the future and doesn't know how to plan and doesn't know the rules, then you're in real trouble. So the point is going back to your surgeon, then what is the point of asking someone to advise you? Is sort of like this is the first time they've done a BAD-R claim or IHT claim or an HMRC inquiry. So then you're not in safe hands.
Yeah, no, it's so interesting, Chris. I think the point I'm about to make, a lot of people listening to this will resonate with. And then I'll tell you why I think it was a mistake for me. So a common belief that I held for a long, long time was I hate accountants and lawyers. And the reason why is...
Present company accepted.
Obviously, well, you're the one that turned me around, Chris. You turned me around. So I hate accountants and lawyers because they bamboozle me with a lot of gobbledygook that I don't understand. And I don't like any profession where I have to pay more money, because if you're paying by the hour or whatever, like the longer a job takes, the more money it costs me. And conceptually, I can see why I had that belief. Because if you don't know the other person's competence, right, or you're not able to judge the quality of the work, right, and you're taking their advice, but then they could tell you it takes 10x the length of time that it does, and therefore you're significantly overpaying. You could be significantly overpaying and not know it. And obviously, over time, and with the story that you just gave, that's could be a very, very, very expensive belief to have, right? So the example that you just gave, that cost that lady an extra £100,000 in tax, and it's only a little nuance. And of course, you're not paying for the hours; you're paying for understanding the rules, staying abreast of the rules, and ultimately for that kind of planning ahead. So how typically, Chris, because I know a lot of people that are listening to this, they'll do the bare minimum. So because of that, they avoid their account and they do what they need to do. So they get the statutory accounts filed, and of course they do it at the last minute and up to the deadline and all that kind of stuff. What's a kind of healthy rhythm? I suppose if you were to compare, actually I don't want to pigeonhole Mark or Richard because I don't know, and I guess it's a breach of confidentiality if you share, but somebody who has good practice, so the business owner, they have got a good relationship and they're maximizing the benefit of the relationship with you, i.e. they're getting the full benefits of your knowledge, their accountant's knowledge and experience versus the average business owner who I see abdicate in a major way. Like what should some of the people listening to this podcast do What kind of frequency of communication? How would you encourage them to engage with their accountant?
Well, I think the problem is that, and I'm not saying there's anything wrong with this, but you might say, well, it's not worth me talking to him because this will cost me money. But like with the bad R, the problem was that the guy should have known that anyway, and he should have been giving them proactive advice. So a lot of it is you could have a discussion with your accountant, but if they're not proactive, so we're going to see a client next week, and he said, we're thinking of changing our accountants. And I said, do you mind telling me why? He said, yeah, because every time I go down the pub, Joe at the pub says, I'm doing it this way. And I ring the accountant up and I said, can I do that? And he said, yes. I said, what, you're telling me that for the last 3 years, I've never claimed that relief? Why did you not tell me? Why have you never rang me up and said, we can do that? So to give you an idea, one of the things we're doing at the moment with our clients is we're picking the phone up, as we've done with you. And we've said, look, do you really want a limited company? Now, I'm not saying ditch a limited company, but to give you an example, with the adverse changes of tax, so in the budget from the 1st of April this year, companies are paying 25% corporation tax from last year 19% if their profits are above £50,000. And the dividend tax rates have gone up. So let's assume that someone earns, let's just say, £150,000. And let's assume it's an owner-managed limited company, i.e. the limited company has to pay corporation tax on its profits. So if its profits are, say, £1 million, that company's paid £250,000 corporation tax. So you're left with £750,000. And this is an owner-managed company, so the guy owns all the shares, and therefore he wants to live on money, so therefore he's got to take that money out by salary or dividend. If we assume he takes it out by dividend, the dividend rates go up to 39.35%, the highest rate, or 33% if you're between £50,000 and £150,000. So you're looking at tax rates of either 64% or 58% because you're paying corporation tax plus income tax. However, if part of that business was in an LLP, it only pays income tax. You don't pay corporation tax in a limited liability partnership. So there's two types of partnership broadly. There's the old 1890 Partnership Act. So when Wild Bill Hickok was running around Dodge City, we were bringing in partnership tax law. And the 1890 Partnership Act is not a long one, but it's a good read if you're inclined. And now what they then brought in was a limited liability partnership. So it's taxed exactly the same, but you have the protection of the value of incorporation as you do with a limited company. The difference is you only pay one rate of tax, which is income tax, rather than corporation tax plus income tax. So therefore, in that scenario, you could have an LLP and a limited company, which is probably a better scenario if you're earning £1 million a year, but you'll be paying a maximum rate of income tax of 45% on anything drawn out of the LLP, rather than 64.35% if you take the same level of income and pay corporation tax and income tax. Now, if no one bothers doing the numbers, or the accountant doesn't even realise that, he's never going to tell you because he doesn't know himself. And the point is, unless they actually explain that and understand it, and sort of going back to your question, if you want to know a good accountant, you ask him to explain it to you in layman's terms, because when I speak to HMRC, I'm talking about Section 198, blah, 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 blah. Well, that'll go over people's heads. You've got to talk to them just like an interpreter does. But if you don't understand it yourself, you're never going to be able to explain it to your clients. And a lot of them just give you 3 pages of verbiage and not actually tell you anything.
Yeah, I love that. That's such a great example. And if you didn't follow, go back and re-listen. And Chris, I often disclaim on this podcast, I'm not a lawyer, accountant, or financial advisor, but obviously I'm joined by one. Albeit you told us at the start I could claim to be an accountant. We just have no qualifications. But in that example, which is fun, the LLP versus limited companies, the purpose of listening to something like this is it should arm you with questions with which to go and ask. And I would recommend, I don't know if you agree with this, Chris, but I would recommend, had some of my best ideas have come from when I've been at a conference or been around other business owners. And I remember one for me, in this business, for the listeners, for my training company, I was at a mastermind meeting full of training business owners. I think Rob was there actually, and somebody else came into the room, who I won't name, and said, "Oh, I've just had this massive R&D tax relief," and I can't remember how much relief they got, but it was into six figures, and several people in the room said, "No, like that can't be done in these types of companies. My accountant said it can't be done," and he said, "Well, I just have, and it's been approved and it's gone through, and I've got the money." And then, so we asked him a load of questions, and that allowed me, and of course, this predates my time with you, that allowed me then to take that information to my then accountant and say, "Hey, what about this?" And they, to be fair to them, they went, "You know what? Never thought about it that way. Let's look into it." And then subsequently, I got a claim. So, for those listening to that, I'm obviously in favor of you getting the best possible accounting advice that you can, and don't abdicate. I'm in favor of a dialogue with your accountant, and it is their job to explain things to you, but it's your job to not sit passively, because I think most accountants market themselves as being proactive, Chris, but my experience is a very small percentage of them actually do. So it's your job, if you're listening to this, to listen to podcasts such as this one and get the information, ask the questions. And then if your accountant can't answer those questions, well, there may be you should seek second opinions. Because I also think, Chris, it stuns me how many times people take what their accountant says as gospel, right?
Yeah, I think you can't sort of, I think whatever job you do, you've got to have a decent knowledge of what other people do, so that then you can ask relatively cogent questions. And if accountant can't answer them, then the chances are that if that's a basic question, then what you get them with a complicated one. Now, what you've got to find is that even though you could be qualified, we do something called CPD, which is professional development, continual professional development. And the way I explain that to people is, if I go to my doctor and got a headache, I don't want to know the best headache tablet 5 years ago. I want to know the best headache tablet today. So because tax law changes, HMRC guidance changes, company law changes, we've got to be up to date with that lot. And to check we do it, we have a professional body that are on top of us. So the point is, if you have an accountant that has no professional body, the chances are they're not up to date technically. B, what some accountants do is they just want an easy life. So some of the accountants we come across, they're qualified, but they're just basically glorified bookkeepers. And they don't want to do anything that's complicated, and they'll never advise you anything complicated because they want to shy away from it. And what you'll often find is some accountants will say, "I don't want to get involved in HMRC inquiries because I don't want to upset HMRC, because then all that happens, if I upset HMRC, I'll have a black mark." But, what you've got to be aware of, if there is an HMRC inquiry, you don't know what questions to answer and what not. So I remember one client, we had an HMRC inquiry, and he had 14 questions. And he said, "Oh my God, this will take me ages to reply and cost me a fortune." And I said, "No, it won't, because the first 8 questions we're not going to answer." So things like, if I'm self-employed, I think one of the questions was, "Can you give me a mileage breakdown and tell me the mileage breakdown of how you get to your motor expenses?" Well, the answer is no, I'm not going to, because there's no requirement for a self-employed person to keep a mileage log. But the point is, you're not going to know all that lot. One of the other questions, I think it said, there's an inquiry into the accounts, say 31st of January 2023. Can you tell me why your expenses for the year ended 31st of January 22 went up and then dropped in 23? Well, the answer is no, I'm not, because you're out of time to ask questions on 31st January 22. But if what you often find is the accountant wants to be overly helpful, what they do is they end up giving HMRC so much rope, they hang themselves.
Right.
And if you don't know the legislation, or what you'll find, and this happened with a Code of Practice 9 inquiry we picked up, the guy had answered loads of questions he should never have answered because he never had an obligation to. But they don't know, because they don't deal with this stuff on a regular basis, and they've got no idea. And then if they did, they don't want to upset HMRC.
A risk of pushing too much business in your direction, Tristan, and you not being on top of being able to handle all my things. I will say, I've never seen any firm be so militant in their pursuit of HMRC to get them to answer, follow the protocol. And I suppose it'd be good, Chris, to bit of the sidetrack to let's talk about HMRC, because I think there's so much fear in business owners, especially when they their first inspection even. Well, I remember my first VAT inspection a very long time ago now. I was mortified. Now, thankfully, nothing was found and it was all kosher. But equally, it was exactly the same with inquiries. And I wrongly had the belief that HMRC always follow protocol, and that it was mass fear. So I suppose my question for you is, what would you say to somebody that's, whether or not they're facing an inspection, an investigation, right now of any type, or what do most business owners believe about HMRC that is just outright wrong? What are the false assumptions?
So, I don't know if you've ever seen a TV program with a nosy reporter, and some of the questions could be, and I'm not suggesting you answer this. It's a case of they stick a microphone in front of you, say, Dan, how much did you earn last year? Right. How many kids have you got? How much is your mortgage? Well, none of your bloody business. Now, with HMRC, I remember talking to an inspector, and I said, you can't answer the questions. He said, yeah, but if they don't tell me they're going to answer it, then I get the information, don't I? Right. So if I don't ask, I don't get. So what you just do is say, thank you very much. Please advise me what legislation you're asking that question under. And then the next time they just won't refer to it, because there is no legislation that gives them the power to ask that question. But you've got to know what the legislation is. And if you don't know the legislation, well, why is the client paying you?
Yeah. It's amazing for me. And Chris, obviously, I don't want to speak to you right now, but we're dealing with an inquiry right now where it defies logic, or it doesn't make sense, or it seems like the left hand doesn't know what the right hand's doing. So to a degree, you need to be guided well. If you're listening to this, you need to be guided well and know the procedures and know the protocols, because it's not like it's an efficient running machine. I mean, you were telling me the other day, Chris, what's the average response time to get an answer from HMRC now if you send them or request information? What's the average length of time? It's ludicrous.
Okay. Let me give you something that's just been announced today. HMRC has told us, i.e. the general public, that in order to expedite matters, they're closing the VAT helpline. This was announced today. Wow. And the idea is they're closing the helpline because then people can answer more letters. But the letters aren't getting answered. So we've been waiting 3 months for a client to get a VAT number. So in the old days, we'd ring them up, but now they're closing the helplines because they don't want to accept the calls because they've never dealt with the correspondence. So HMRC say they're supposed to deal with correspondence within 28 days. We're not even getting acknowledgement of the receipt of the letter within 28 days. So then what happens is then we do an appeal, and then the appeal letter doesn't get dealt with. And all what you find is because they're not dealing with anything in an expeditious manner, then they get a second letter or a third letter, then a complaint letter, which creates more problems. Now, the response so far has been, well, the staff have been moved to deal with COVID. So what you may remember is that they had CBIL loans, COVID business interruption loans. Now, if you wanted one less than £50,000, then generally in the height of COVID, I've gotten some clients that was asking for the money at 9 o'clock in the morning. It's in their bank account by 3 o'clock. Now they're saying there's fraud of over, I think, £980 million. So they said that we're going to chase the money up, and they say they're moving staff to those departments to chase it up. But a lot of that they'll never get back. And the trouble then is that's going to be a write-off for the Exchequer. But then there's no staff to do the day-to-day correspondence.
It's stunning. It's depressing. Well, and that's what leaves you with inquiries that's multiple years old, right? That just never seem to get closed, because I know there's, for an inquiry that I've had, that there was Oh, I don't know how many inspectors, 3, 4, 5 inspectors over several years. And it actually feels like, well, we haven't got anywhere. Not really.
Well, to be fair, when we were appointed, a long way through the inquiries, we managed to close one of the 3 years. We managed to close one in short shrift. So all you have to do is try and cut down the items that they can tackle and try and deal with sort of the easy ones first. But that hadn't been done before.
Yeah. So let's take our hard right now. Let's move away from tax and let's talk about wealth building. So people listening to this, most business owners, they're trying to build wealth for themselves. So, you mentioned it's kind of a side note about an example of using an LLP structure rather than a limited company and how it can be more tax efficient from an income perspective. But if somebody's listening to this, and let's say, Chris, typically they've got a limited company of X size, low 7-figure revenues, and it's churning up a reasonable profit margin, but they're trying to go, okay, how do I build some wealth, prepare for retirement, etc. What are some strategies that they should be looking at or considering, or at least discussing with their relevant advisors?
So if you're a high rate taxpayer at the moment, then generally what you want to do is to create capital gains rather than income. So capital gains tax was brought in on the 6th of April 1965, and generally it hasn't been higher than the basic rate of tax. So the highest rate of capital gains tax is 20% for the sale of shares, other things, but 28% for the sale of residential property. So if it's 20%, that is the basic rate of income tax. And the thing about capital gains tax is, unlike income tax, the bigger the figure, the rate doesn't go up. So income tax, the more you earn, the higher the rate of tax goes up from 20, 40, 45%. So the highest rate of income tax is 45% if you earn more. And in that case, if you earn more than £150,000. Capital gains tax is a flat rate of 20%. So if I was a high rate taxpayer, I would be going to create capital assets all day long. Now, if in the scenario you're talking about, and if I'm looking to exit, I'd want to maximize my BADR, business asset disposal relief, which means I'd want to ensure that I've got my maximum reliefs. Now, it could be that if I am in the twilight of my life, I would want to give money to the kids. Now, it may be that I could give them shares in the company without crystallizing capital gains, and there are ways to do that. And I could possibly, if I plan it properly, get them to qualify under BADR, because if I've got a trading company and they've got 5% of the shares, so let's say I've got 18 kids and a wife, that's 20 people who could have 5% of the shares. And if they're all on the payroll and we satisfy BADR and they've had those shares for 2 years prior to the sale of the company and their employees or directors, then they could all get £1 million at 10%. So I sell my company for £20 million. Everyone makes £1 million capital gains tax if they own 5% of the company each, and no one pays more than 10%. Now, I haven't got 18 kids, but that's the thing.
I was going to say that's what finished me off, Chris, I think.
So, but you can do planning like that, and it is possible to revise the planning. So you could say, well, is it too late because I've got 100% of the shares and I'm planning to sell in 5 years' time? Well, the answer is no, because there's a spousal exemption on capital gains tax between spouses. So I could give my wife at least 5% of my shares today if I own 100%. And then if she is an employee or director, and if I'm going to cash out in 6 years' time, that's more than the 2-year minimum required for BADR. Therefore, she could get BADR relief and I could get BADR relief. And if I wanted to give any to the kids, I might be able to do that as well.
So here's I really like that. Here's something that I hear that I think many listeners might be trying to do. There's quite a few people in my world, Chris, where they've got their trading company, it's operating well, it's making a profit, and they go, you know what? I want to use this money to invest in property, right? I mean, clearly there's more asset classes than just properties and stocks and shares, but there's people that go, hey, I want to invest in property, so I want to use my trading business that I work in day to day, but I want to build a portfolio which is going to give me a rental income. The most common way that I've seen it done is people going to go, okay, I'll have my operating business, lend, I'll create an SPV, which is going to buy the property assets, and therefore there's an intercompany loan. What considerations are there relative to that, or are there other ways of doing it that they should give consideration to first?
So one of the popular things at the moment is a family investment company. So if it's a property company and you're investing, say, residential property, then that isn't a trading company. So you can't get business property relief for inheritance tax. You can't claim some of the capital gains tax exemptions, say holdover relief. But what you could do is you could say, well, I want to give the kids a head start in life. And so you could say, set up another company, and let's assume they're not minors, i.e. they're over 18. Then if they wanted to own that company, mum and dad could lend money from their company to the kids' company, and there's no obligation to charge interest. There's no tax implications on loans between limited companies. And that could be the seed capital, i.e. a loan, that would get that business up and running, and then the ownership of that company would be owned by the kids. Mm-hmm. Now, that means that they will then create, hopefully, a value in that company, which is all started by the loan from mum and dad. And mum and dad have also done a very good inheritance tax planning tool, because that company is out of their estate because they don't own the shares.
Yeah, I like that. And I believe that's not dissimilar than how Donald Trump got the seed capital from his father, that small loan of $5 million, I think it was, or something like that. But I'm speaking a little bit out of turn there. I can't claim to know Donald Trump personally. Okay, and let me push you a little bit further on this one, Chris, because it's obviously interesting. So my children are currently 13, almost 14, 12 and 9 at the moment. So they are still minors. So if I'm trying to create investments for their future to kind of give them a kickstart in life, any suggestions about where I should start thinking about that, or somebody who still has children who are minors? What things should they look at?
Well, to start with, you've got to be aware of the settlement legislation. So there's a famous case of Jones v. Garnett, and is also known as Arctic Systems. I don't know if you've heard of Arctic Systems case.
No, I haven't.
But okay, so what happens with Jones v. Garnett is the husband was a computer consultant. I can't remember the exact figures, but let's say he earned $200,000 a year. And his wife didn't have any income. And he invoiced it all through his limited company. So his accountant said, I've just realised you're going to pay income tax on $200,000 by taking a dividend from your limited company, because $200,000 is the profit after tax of the limited company. But your wife hasn't got any taxable income. If you earn over £100,000, you lose your personal allowance by £1 for every £2 of income. Your personal allowance is £12,570. So just over £125,000, i.e. £100,000 plus 2 times £12,570, you've lost your personal allowance, right, which means that the first pound of income you earn is taxed at 20%. So, however, if we gave $100,000 to your wife dividend, $100,000 to you, then neither of you are into the higher rates of tax. Neither of you lose your personal allowance. And he said, well, that's fantastic. What do I do? And he says, well, get her to have a share for £1, and you've got a share for £1, and suddenly it's not 100% owned by you, it's 50%. And HMRC said, well, wait a minute. So they opened up an inquiry. They said that there's no way that £1 would be the market value of the shares if from that £1 you get £100,000 dividend each year. So we think that's a bounteous settlement. And because it's a bounteous settlement, we're going to tax it all on you. So basically, that doesn't get you anywhere. And they flip-flopped through the courts, and the taxpayer lost all the way up to the House of Lords, as it was then. There isn't House of Lords anymore. But then what happened is that they came up with legislation, spousal legislation, that says that there isn't a bounteous gift between spouses, i.e. there's no capital gains tax between spouses. If I give shares to my wife, irregardless of the value of the shares, it doesn't create capital gain on me. By the same token, gifts from parent to child, if they are minors, are taxed on the parent, because HMRC is saying that if it was that simple, all your multimillionaires would give a big chunk of their money to the kids, and they've got a personal allowance same as you and me. They've got a basic rate tax band, you and me. So it's not that simple. However, there are ways around it, such as other parts of the family, such as your parents, i.e. the child's grandparents. There's things that you can do to take advantage of that. But parent to child, income is trouble, capital gains tax, not as trouble, not as much. So it's just a case of how you structure it.
Yeah, so two questions, Chris, because we're kind of on the tail end here. Two questions. I mean, I want to, you and I privately have exchanged a few kind of good books for people that are, whose attitude have been, appetites have been whetted by this conversation that I want to come to. But before that, you know, sometimes entrepreneurs typically have big pictures, sometimes hate the details. And the objection is like, oh, it all just changes. Like the tax legislation is goodness knows how many tens of or hundreds of thousands of pages, and the rules are always changing. And it feels like if I get it wrong, I'm going to get smacked with a hammer and tied up in knots over investigations and battles. But if I get it right, all of a sudden, my single biggest expense category, you know, like you're talking about earlier, income overall, you know, the tax burden being in the 60 plus percentile, that can go away and be significantly reduced or minimized. What would you say to me? It just kind of goes, oh my God, but it all changes. So you said something on this podcast, but if the Chancellor gets up tomorrow and decides to change the rules, it's all going to get unpicked. How does a business owner not fall foul of that?
Well, it's simple. It's strengths, weaknesses, opportunities, threats. Is it an opportunity? Yes. By the same token, if I was a business owner and I was a financial journalist, and I said, oh dear, I'm just going to lose my job because of ChatGPT. Well, you just have to work around it. I mean, I think it's Macmillan. They said to Macmillan when he was the Prime Minister, what's your biggest concern? And he said something like, events, dear boy, events. Well, events happen all the time. Tax changes. You just have to change with it. I mean, when I started, without giving anything away, I'm older than 21. And when I started, the income tax was 83% and they had investment income surcharge of 98%. So all our time was spent on creating trusts, offshore structures. Well, now you don't need it because tax rates aren't the same. So you just have to adapt to it. But what you find is a lot of accountants never adapt. They set something up and say, well, I set a limited company up for you for 20 years and that's good for the next 50 years. Well, no, because you've got to change with events and you just recognize how things change and you adapt accordingly. But if you don't adapt, that's where your problem is.
Right. I love it. Well said. Well said. And yeah, it's funny when people freaking out. Don't get me wrong, I'd rather the corp tax have not gone up to 25%, and a lot of people are going to bear the consequences of that. But yeah, when the tax rates you're talking about back in the Beatles' classic song "Taxman" speaks back to those days of 98% tax. It's so basically on that positive note, we could be saying that things could get significantly worse. Right, Zach.
But I think you'll find that case was George Harrison had just had an HMRC inquiry, which is why the Taxman song evolved.
Right, I love that. Right. Well, so Chris, so finally, I mean, I'll put links, etc., in the show notes. But finally, for anybody that's enjoyed this conversation or wants to, well, obviously find out more about you, but I'll put links to you and Wilkins Southworth, your firm. But let's talk about books. So I'm a voracious reader, and we often exchange books. Are there any particular books that you recommend if people want to get into the world of tax, perhaps, or without having to sit down and read the tax legislation?
Well, it's sort of, I've got to be slightly careful here because to me, it's also interesting. And it depends how interested you are. I sent a book, quite what I thought was an interesting tax book, to a client, and I found it was the thing that opened his door, and it was just his door stopper. It says, "It's just get too turgid." So it depends your level of knowledge and how interested you are in it. But I mean, there's a guy called, I think it's Richard Brooks, who writes in the City for Private Eye. He's written a lot of books, and you've got to sort of have a sort of jaundiced view, but he was an inspector of taxes, and some of the stories that come out there are quite interesting. You and I have been looking at one called Treasure Island. I think it's the guy Shaxson, Shaxson, but that one's very interesting. I mean, there's a lot of stuff. It depends how much detail you want. I mean, I'm talking, these are sort of like international transactions, double taxation treaties, stuff like that. You can see how Apple avoids tax by doing what they call the double Irish. How you can avoid tax in Belgium because there's no capital gains tax. How Apple, they've got an office in Cupertino. All their profits, however, sit in Luxembourg. And it was cheaper to them to borrow the money to build their new office than repatriate the profits from Luxembourg. And it explains why, etc.
It's fascinating, because I mean, the two that I'll mention this. There's one you've already alluded to, Treasure Islands, which was just, I kept sending you photographs of pages after you said that to me, and I could not believe it was kind of a history, but really interesting history, especially of the British Empire, and how the tax havens out the world were, spider's web from London, and how it's all really controlled. And it's a little bit conspiracy theorist, but a credible journalist writing. So very fascinating read, and one that I absolutely love, which I think is still number one in its category on Amazon at the moment. It's called Taxtopia, I think, which again is written in quite a pithy style, but somebody talking about the rich, whatever that means. The rich being defined as anybody that's got more money than you do. The rich in their approaches to tax around the world, which is always interesting. So Chris, I've loved this conversation. I love it. Bang on the money in terms of the time that we allocated for this. So I will put all the details in the show notes. If you like this interview, guys, please comment, let us know, and let us know if you want to hear more from Chris, and we'll get him back again in the future. So Chris, thank you very much.
Thank you, Dan. Nice to speak to you.
Damn good interview, my friend. He does sound like a smart dude for sure.
Yeah, I mean, look, and we only just scratched the surface, right? And since that interview was recorded, he's since said, "Oh, we didn't add in this, and that's the point, right? You want somebody that obsesses over it, like that is just constantly reading journals and coming to you with ideas. And the fact is, most accountants will tell you proactive. My experience is they're not. In fact, even if you've got somebody as great as Chris, you need to be proactive. Yeah. And so specifically, if you ask your accountant these questions and they don't have good answers, to me that is a massive red flag. And I'd say, drop me an email, get in touch, and I'll happily send you in the right direction.
So listen up. This is you're about to drop some really cool business strategies in the area of accounting bombs. So let's hear, what are the questions?
Right. So let me preface this by saying, in isolation, the questions aren't worth the sizzle. You've got to listen. It's in the answers, right? So, number one, how do I manage cash flow? But
now these are questions you ask your accountant.
Correct. So, as in, if you're sitting and listening to this, like, you want to have coaching, that they should have expertise and be able to guide you about where specifically your cash flow is weak. Are your receivable days too high? Are your creditor days too low? Right? If you don't even know what those terms mean, that's an example that they should be able to guide you. Say, we've noticed your receivable days have...
And if they don't know those terms, fire them immediately.
Right, correct. So, because ultimately, and just to tease, I mean, the quote of the week this week is from arguably the greatest CEO in history, and most people don't even know this guy's name, and it's always in the cash flow, and most people don't know what that means, or they get bamboozled.
That was going to be the quote for the next week's finance category, but since you've already teed it up, we'll kick it up front.
No, they can wait. They can wait and keep listening next week.
Oh, okay. There we go. Great tease. So what you meant to say was that the next week's quote of the week is for one of the most successful CEOs.
Yeah, correct.
Well, it's not even next week. It's in 6 weeks, because it'll be a 6-week before you get back to accounting. There's a hell of a deep tease right there, brother. Well done. Pro-level deep tease.
We'll get there sometimes. The second question to ask is understanding what are my tax obligations, right? Because how this one shows up is most people are so reactive, and literally the accountant says at the very last minute, 9 months following the year end for UK limited companies, there's a mad scramble to get the company's accounts in, and then of course the corporation tax is immediately due.
Not just something that happens in the UK, but
yeah, well, I'm talking about specifically the time window, but right. So therefore, people they're going to go, well, I don't know because your bookkeeper hasn't given me the data. Well, okay, I need to understand what my obligations are so I can provision cash. So that ties in with point 1, right? And most people don't. So you need to understand what your tax obligations are. Third question would be, okay, what are acceptable deductions, or what are tax breaks that I'm not currently taking advantage of?
Interesting. Yep.
Right, because if you think about it, most accountants, you're just paying them to be legally compliant, right? And that's what you pay for, and that's what you get. But in my view, that's just table stakes. That's just table stakes. You have to do that as a minimum because you're going to file returns, you're going to file CT 600s, etc. But actually, that's where all the value can be added. But most people don't even ask. They just assume that the accountant knows. And in the interview, we spoke about a few examples of these reliefs, but and I alluded to in the interview, but I had one case before Chris was my accountant where I was at a mastermind meeting and somebody said, oh, do you claim this tax break? I went, no, not possible in this industry. Right, that's not possible, doesn't it? I was aware of the tax breaks. I was already ahead of a lot of the population, but I presumed it didn't apply to me until somebody showed me that it could. Now that doesn't, and then you take that information. That's the value of being in mastermind and being around smart entrepreneurs. And I took that back to my accountant, and he was aware enough to go, okay, let's have a look. Wow. Oh yeah, maybe that can work. Right, so I think that you need to be super on top of your cash flow. I think you need to be super on top of what tax breaks you are. I think another one is you need to be dialed in with how they communicate with clients. Like what is the frequency?
Yeah.
I don't want somebody I'm building a relationship. In fact, I don't mind saying it in here. I won't share your age, Chris. But when I started working with Chris, ultimately I said how long are you planning on staying in this game?
Okay, so you just called him old. That was
no, he's a successful dude, so he doesn't need the money. And I'm kind of going, okay, are you winding down?
Yeah.
I want to be ready because in my head, I'm still going to be in business.
By the way, that was a really. I don't want us to overlook this. I think you brought up a very important point, so important that it's worth repeating, which is that. I think it's safe to assume that most business owners have a false expectation of reality for their accountants, thinking that accountant is committed to finding them all of the savings when they're not. They're just committed to keeping them compliant. That's really a cool distinction, Dan.
Yeah, that is true in 80% plus of the cases of all the small business owners I deal with, at least. So you need to stay dialed in. I can't remember what the point was that I was saying before. It was probably important, but we'll put it in the next podcast.
There we go. In the meantime, let's jump on to the book of the week.
Yeah, so funnily enough, the book of the week this week was going to be different, but actually my accountant and I have got a secret fetish, which is for kind of...
You are weird about this, by the way.
For kind of financial crimes. And so he and I are constantly texting each other backwards and forwards books about things like, the Enron scandal, how it happened, etc. Because I want to avoid being taken advantage of, etc., whether it be as an investor or from a tax point of view. And the book of the week this week is The Signs Were There. And it's by a guy called Tim Steer, who's like a financial journalist. Mm-hmm. And he talks about some mega companies that you all know internationally renowned companies that failed dramatically, and that the clues were already in the accounts. So they're public companies, so you could have seen that they were heading for the wall, but it was missed, and then all the shareholders took a wash. So it's written in a style for the layperson. You don't need to be an accountant to read it, but it will also educate you. So it's entertaining as hell because it's real life examples, but it will educate you in the accounts, what to look out for, and then of course it's a bit of a warning if you spot the same errors or trends in your own accounts. Indeed. So the signs were there. Tim Steer.
Very cool. All right, let's move on to the quote of the week, which is a bit tongue-in-cheek this week.
A little bit tongue-in-cheek. Never call a good accountant, a credit to his profession. He's actually a debit to his profession. And that is a seriously financial geeky joke there, so I've probably alienated the whole audience, but there you go.
All right, my friend. Take us out. Lead us with your words of wisdom, buddy.
Well, look, what this particular episode is about, and all this podcast is about, is if you want a better business, you need to be a better business owner.
I hope you enjoyed that episode. 3 things you need to do now. Number 1, make sure you subscribe to this podcast so you do not miss an episode. Also, get on over to Amazon to get a copy of my latest book, Turnover is Vanity, Profit is Sanity, 9.5 steps to improving your profits and cash flow. Also, join our Facebook group, the Turnover is Vanity, Profit is Sanity community, to connect with other business owners.